Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 239th VideoCast podcast for the week ending May 16th, 2024. A ton to cover. We'll do a quick family update and others, and then we'll get right down to business. Here's a picture of Caitlin with Annabelle when she was just a baby. So happy Mother's Day to everyone who celebrated over the weekend. Just amazing what mothers do, and Caitlin in particular. So that's before and that's now. Same great woman, different great hair, and moving right along before I get myself in trouble. That's my mom came up with the girls, with Mimi and Annabelle. We had a wonderful dinner out. This was at Yahoo in the city. There's 770 Broadway where their studios are located. And some of you have seen these, but we get new viewers every week, and they like the behind the scenes views. That's the TV studio there with the ticker on top. That's the broadcasting booth where they cut them up. And Yahoo does a great job of cutting the clips super quick. By the time you walk out of the building, it's posted on the internet and emailed to you. It's pretty amazing. That's Josh Lipton. He used to be on CNBC. He's now anchor at Yahoo. And that's that. Moving right along. Got to play Maidstone again this year with Lou Bassanese, my new friend this year. He is a regular commentator on both Cavuto and Varney & Co. on Fox Business, and he's on multiple times a week. You definitely want to check him out. That's his Twitter handle, Lou Bassanese, Basenese. And I got to say, you can't make a mistake playing Maidstone out in East Hampton. There's nothing like it. But yesterday was like weather from Castaway with Tom Hanks. I mean, it was cold. It was wet. It was rainy. It was windy. You add it all up, and then the brilliant organizers decided to wait a half hour to put everyone out, which made it even worse. But we got a half a round in. We had some fun. Amazing hospitality in the clubhouse, and obviously pick up your Maidstone stuff in the pro shop. So we just had a blast, and I'm sure we'll get back out there when it's sunny again. But that was that. And here you can see I've got like 5 layers on by the 8th hole, and as I got to the locker and took all these off, it was just soaked through every single layer. I kept digging for layers in my bag, and that's the kind of day it was. So, and then we've got a couple quick things. They had water polo, the girls, this week. Greenwich beat the Brooklyn Hustle. Few quick goals here because that's how we do it. And they only take a half a second. There's Mimi looking for a pass, can't find it, buries it. So that was pretty exciting for this week. And then we won't cover them all, but there are only a couple. Here we go. Yeah, there we go. Caitlin, watch. All right. I'm going to get some slack for that. And then Annabelle. Boom. Okay. That's about as little as time as I can take on that. It's exciting for me. I'm not sure. I think half of you it's exciting for you. But leaving that aside, I want to thank Varney & Co. and Mark Smith for cutting me actually into Lou Bassanese's segment on the meme stock mania, short segment also with Lauren Simonetti and Stuart Varney. So that was cool. First little clip in there about the meme stocks. It's only literally, I gave 15 minutes of interview content for like 15 seconds of spot, which I'm very grateful for, but it's just a couple words on the memes. The interview with Yahoo, however, was more comprehensive with Julie Hyman, and want to thank Haley Marks for putting me on as well. This one, we updated our PayPal thesis, so we're going to listen to that now.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're dissecting the battle of financial services between fintech versus traditional banking. Joining me here to discuss is Great Hill Capital Chairman and Managing Member Thomas Hayes. Thomas, good to see you.
Great to be here, Julie.
Yeah, what they call TradFi versus FinTech, I guess, if you're in certain segments. But let's get to the FinTech first, because that is the stock that you like. Although it's sort of an older one in the universe of FinTech, and that is PayPal. The stock has had a bit of a rocky run, but let's get to why you like it. First of all, there's a new CEO, and there's been a lot of optimism sort of baked in there with the company coming out with its latest results.
Yeah, Andrew Chris came from Intuit. So he ran the small business division at Intuit, which was 50% of the revenues. While he ran that division, the stock was a 40-bagger over just over a decade. So he's bringing some of that experience to PayPal to revitalize the brand. He put out the 6 initiatives, which he said was going to shock the world. It fell a little flat,
yes,
except for the fact that he's delivering on it. We saw them, he set expectations low, he set guidance low, and he beat already in the first quarter. And the big problem that everyone was worried about with PayPal was margin contraction. We saw an expansion of margins in that first quarter by 98 basis points. That was a good deal.
Yes. All right. So let's talk about what we've seen happen in the stock here, re-rating perhaps.
Yeah. This is a big deal because the stock trades down to 15 times earnings relative to the general S&P at 21 times. So why? Its historic multiple is about 30 times. As margins contracted and growth slowed, that multiple contracted. Now what you're seeing is a re-acceleration since Andrew Chris came on board. Margin expansion, you saw total payment volume up 14% last quarter, revenues up 9%, earnings up 18%, total transactions up 11%. So as we get more consistency, a few quarters under his belt where the market can believe that margins have stopped going down and revenues continue to grow, earnings continue to grow, cash flow continues to grow, we could see a multiple expansion on top of the business expansion, so maybe back up to 18 times, 20 times, 22 times. I don't know if we're going back to historic multiples because the halcyon days of the 30% growth may be behind us, but a normalized multiple would really do a lot to raise the stock price from here.
And then there's one more financial metric you're looking at, and that is free cash flow.
Yes, this is my favorite metric. This is the one that can't be manipulated. They generate about $5 billion a year of free cash flow. It's amazing that I'm talking about a turnaround situation that generates $5 billion of free cash flow, has got $9 billion of cash on their balance sheet, so all the runway in the world. And further to getting the stock price up, they're actually using that free cash flow to buy in stock. They're buying about $5 billion a year. At a $67 billion cap, they could buy in the entire company in 12 or 13 years. So we like that situation. We like that it's cash generative, and that gives them all the runway they need, in addition to the $9 billion on their balance sheet of cash.
Interesting. All right. We always like to talk about what could go wrong in a scenario like this. And that's made, there's a lot of competition in this space.
Yeah, there's no question. Obviously, Apple Pay is a big threat. Everyone's worried about that. The regulators are cracking down a little bit on Apple, not being able to control everything. The other thing is the historic legacy fear of Braintree. They actually have 10% of global enterprise spend. They process about $500 billion of $5 trillion. So when you think about
PayPal, that is.
PayPal through Braintree. So when you think about people's like, oh, I don't use PayPal anymore. Oh, have you used Uber today? Have you used Ticketmaster?
So
have
they
you
do
used
back end,
Booking?
is what you're saying.
You bet. And that's where they're starting to get a bottoming, a troughing of margins, and they're starting to reaccelerate because they're bringing data, they're bringing AI, they're bringing faster checkout, higher conversion at checkout. So now they can start to charge a little bit more.
Interesting. Okay, and you own PayPal.
We own PayPal. It's a big position personally and for clients.
Okay, let's get to the stock you don't like. This is very much a traditional finance company. Talking about Goldman Sachs, the stock's actually rallied back pretty nicely over the past year. So let's get to why you don't like it. You think it's still too dependent on trading profits, but isn't that like part of the reason you buy Goldman Sachs?
Yeah, well, let me clarify. We like Goldman Sachs. We don't like Goldman Sachs at today's prices. Okay, so we wouldn't put new money to work in Goldman Sachs. It's doubled since the October lows. It's run ahead of a lot of its opportunity. A third to a half of their business, though, on any given quarter is trading profits. So it's eat what they kill. If you have low volatility or you have a miss in trading profits, it's too lumpy in terms of the long term. And they're getting a premium right now. They're trading above their average multiple. They're trading about 1.4 times tangible book. Peak cycle, maybe they can go up to 2 times tangible book, but one time it's a bargain. They're kind of in that middle of the range space. So am I excited to put new money to work after they've just doubled in a few months? The answer is no. On a pullback, would we get interested? Potentially, but it would have to be a very nice pullback.
Okay, and we can also say, and this is your point number 2, the thing that they tried to do to become less dependent on trading profits didn't work out so well.
Complete train wreck. So, the message is blurry. They tried to do Marcus for many years. They tried to do Apple Card, credit card. They tried to get into the credit card business. That's not their bread and butter.
Right.
What they need.
Perhaps to David Solomon, CEO David Solomon's credit, he said he sort of cut their losses in that. He said it didn't work. We're done. Yeah,
leaders always come to the correct conclusions after trying everything else. But leaving that aside, I think the message is getting clearer, and they do want to spend more time building out the reoccurring revenue businesses like the asset management, which is a relatively small portion of their overall business. To point one, every quarter they got to start from square one.
All right, and let's get to the third thing here, that we need a rate cut.
This is a key. They've got a peerless investment banking franchise, M&A, debt refinancing, IPOs. It's just been a little bit anemic with such an aggressive rate hiking cycle over the last year and a half. 2021 was amazing, 22, 23. Anemic. It's starting to come back in fits and starts, but we're really going to need to see a cut or 2 cuts for animal spirits to really kick in, the M&A game to get on, boards to say, I got to buy that company before someone else does. It's time to refinance all of our debt. It's time to do equity offerings. And then for companies that want to go public, now's the time animal spirits are back. We're not quite there yet. I think a cut towards the back half of the year, and that may take a quarter and a half, and that's why we're probably a pass on Goldman for new money at these levels. But on a pullback, we would consider it to have to be meaningful pullback, though.
Gotcha. Okay, so pullback, we talk about what could be the upside case here. The other one would be, as you mentioned, if there are rate cuts.
Yeah, and they could come sooner than we expect. We saw the jobless claims yesterday were higher than expected. And Chairman Powell was very explicit about that. Yes, we're watching the inflation numbers. He's kind of in the camp that we all are, waiting for those owner equivalent rents to come down. They've just been stubborn. We all look at Zillow rents and everything else. But he did make an explicit note about the labor market, because that's the second part of the mandate. And we're seeing some signs that maybe that's softening a little bit, which could give them cover to at least do 1 cut. The earlier they go, the less they're going to have to do. If they were to go over the summer, which is lower probability, maybe they only have to do 1 or 2. If they wait longer till maybe after the election, it might require more cuts.
I love it, Tom. You snuck in some macro stuff for us, which we love. Thanks so much. All right, so let's sum up what you're telling investors here. Basically, you say buy PayPal on performance under new leadership, the play on value add, margin reacceleration, and healthy generation of free cash flow. On the other side, you say for now, avoid Goldman Sachs. It's a little pricey, and it's dependent on trading profits. It's playing catch up on asset management, and it is waiting for those rate cuts to ignite capital markets. Thanks, Tom.
Great. Thanks for having me, Julie.
Have a great weekend. And thank you so much for watching Goodbye or Goodbye. Be sure to tune back in next week for all new episodes at 3:30 p.m. Eastern.
And we're back. And then want to thank Meta Singh for including me in her article on Reuters this week. And finally, a reminder, I'll be speaking at the virtual Money Show on June 13th. You can listen to all the speakers from the 11th to 13th. Tickets are still free. When you go to hedgefundtips.com, I'll have this link up towards the top of the page. If not, just scroll down until you see the post, and you can get your tickets for free for June 13th Money Show. And then want to thank Herb Lash for including me in his article on Reuters this week. And quote of the week, as we get started here, is from David Tepper, one of the GOAT's greatest of all time investors. Did so by taking concentrated, sensible bets consistently over time with a value tilt and special situation tilt. I share a similar type of DNA as to what we look for in businesses with Tepper, and that's never been more apparent than right now. We're going to talk about that in that we saw from his first quarter filings, he increased his Alibaba position by 158% last quarter. It is now his number 1 position size, and as of today's mark to market, approaching just under $1 billion of his assets. And as Buffett says, when it rains gold, pull out the bucket, not a thimble. Big concentrated bets are what made Tepper one of the goats of investing. And that's that. So you can check that out. And then Canada Goose surges 25% on revenue beat, buoyant profit outlook. Here we have the press release. The big story here is they literally blew the doors off of expectations in terms of revenues and then and earnings. But the big growth driver, it's unbelievable. If you look at Canada, it's up a little bit, $5 million. If you look at the US, it's down a little bit. Greater China is up from $287 million of sales to 422 year on year. Let me repeat that. 287 to 422 million. So 2022, they did 288 this quarter. 2023, they did 287 this quarter. Last quarter, 422. This is the luxury consumer in Greater China, ladies and gentlemen. And that's where Alibaba is also going to benefit because they deal with the higher end stuff, not the garbage stuff on Temu. Asia Pacific, excluding Greater China, was also up big time from 66 million to 84 million. That just continues to grow in leaps and bounds. So Asia Pacific, 354 to 506, and total revenue from 1.2 to 1.33, big jump, etc. We'll dig into that one in greater detail on a later call. Want to thank our friends over at RBC. You know who you are. Just to give you some broad market charts so you can take a little look here. We had this cup and handle breakout. I think this is going to persist higher. Now, this is a monthly chart, so you could get volatility here, but I think this is going to push higher. As a matter of fact, BMO took their price target up to this, I guess this is a Fibonacci extension target that Slumer has over at RBC, around 5,600. I was in that's a 2025 camp. I think that's probably still true. But as we covered last week, I do think we're going to see actually more strength into the summer, ahead of that. And maybe we'll get a little volatility and a little weakness into the election with the uncertainty, et cetera. I was talking to a reporter today at Reuters, and I said, we're trading at 21, 22 times forward. We're getting a lot of good news, and a lot of good news is priced in, and we're pushing higher because I think a lot of people got too negative in the hole in that pullback, the 3 to 8% we were calling for. We got the full 7% in futures, I think 6% on a closing basis. And then they stayed, and they were all saying we're going down more as we were covering and sharing on these podcasts. I think a lot of them are now getting a career risk mid-year, and they're going to have to chase up and push up. And as you get more broadening of the rally, even if the indices stall out, like you saw today, little stalling towards end of day, and yet the laggards like Babo's up 7%, and Canada Goose up like 15% today, or whatever it happened to be. So things are rocking there. Let's take a look a little bit more just to see the continuation here. Small caps are starting to come through. It's got to break through. This here has been the resistance. It bounced off. And I think this is going to be the story of the second half. Even if this is a 2025 story for 5,600 on the S&P, we could see a lot of money made in small caps here. Get to new highs while the bigger indices maybe rest a little bit after the summertime. So we continue to be very constructive on small caps as well. And the other thing, this is interesting. The Tokyo Stock Exchange is running up against this all-time resistance. I wouldn't be surprised to see a pullback. Maybe it's going to make a long-term secular cup and handle. Maybe it's going to be a double top. I don't know. We're not big Tokyo bulls. I just don't see how they get there without making an insane amount of babies overnight. And I don't know what you'd have to do to incentivize that. So we'll just take a pass. Hong Kong Hang Seng, it's been the top performer, by the way, since the end of January. We're going to look at some data from there. It'll be somewhere here as we move forward. So maybe you get a little resistance here for the short while, but at the end of the day, we've been saying this looks very much like the Alibaba chart, reverse head and shoulders, and that takes us, a lot further than this. Even if you hit a little short-term consolidation, not really concerned about that whatsoever. Playing the long game there. 10-year yield is rolling over as we had anticipated. When everyone said it was going back over 5, we said it was going under 4. We stand by that. Same thing with the dollar. That was a counter trend bounce. It's now rolling back over as anticipated. So all that's lining up. My friends in Canada are going to feel so rich 2 years from now when that loonie goes back up like nobody's business. They're going to be coming down to the United States, buying real estate, buying buildings with their hockey jerseys on and laughing all the way to the bank. So good for them. It's been a long wait. And then what else did I want to cover out of these charts? I think that's everything we need to see for right now. And then, here it is. China's stealth rally. This is from RBA through my friend, you know who you are. And this shows, contrary to this bleak view, the theme from Matthew Poderba is China's stealth rally. Many investors perceive China's economy is in shambles, plagued by geopolitical tensions, overbearing regulatory crackdowns. The perception has led to near record underweights in Chinese equity among global investors and huge valuation discounts relative to other markets. Contrary to this bleak view, Chinese stocks have staged a remarkable comeback this year and are outperforming most major markets since January. So China is out, US is probably halfway down the list, 10 down the list from other countries outperforming. Oh, and by the way, what's one of the worst performers that everyone's all bulled up on because it's been going up for a couple of years just because of monetary policy and faking everyone out? Japan is one of the worst performers. UK is rocking and rolling. Emerging markets is starting to rock and roll. China is starting to rock and roll, albeit off a low basis, but everything's happening. So there are 3 drivers. Number 1, China's macroeconomic data has beaten expectations. PMIs, GDP growth, exports have come in better than expected, suggesting growth is more resilient than anticipated. China has pivoted away from restricted policies. This is number 2, toward a pro-growth and pro-market stance. Recent challenges resulting from restrictive policies, such as zero COVID, forced property deleveraging and regulatory crackdown on internet companies has given way to increasing accommodation. Since the start of the year, significant monetary easing and rate cuts have been accompanied by heavy pro-growth rhetoric. China's sovereign wealth fund has directly intervened in markets, buying ETFs and stocks, and policymakers announced plans for shareholder-friendly reforms, including stronger investor protections and more stringent capital markets supervision. Icy sentiment towards China has started to thaw. So we saw it in Tepper, we saw it in Michael Burry. We're seeing it across the board. A growing number of investors have begun to turn more constructive on Chinese stocks. Managers' underweight China positions appeared to have troughed, and stronger price momentum has driven some net buying by faster-moving quant and hedge funds. Although sentiment is only just beginning to recover off deeply negative levels, sustained outperformance may force managers to add China exposure to limit drag from their large underweights. Let me repeat that. Sustained outperformance may force managers to add China exposure to limit the drag from their large underweights. Markets may be catching back up to the fundamentals. Historically, Chinese stocks perform well when their earnings are accelerating, but this was not the case during the last acceleration. The recent earnings recovery stands out as an abnormal relative to accelerations in the prior 2 decades, and last year's deteriorating investor sentiment may explain a lot of the weak 2023 performance. If accelerating Chinese earnings and policymakers' continued easing drives a sustained improvement in sentiment, the near record discounts on Chinese stocks may diminish in 2024 as the market catches up to improving fundamentals. So that's the name of the game. In the short term, it's a voting machine based on emotion. In the long term, it's a weighing machine based on fundamental, and now we play the catch-up game to catch up to the improving fundamentals. China's consumer prices rise for the third month, signaling demand recovery. That's consumption, ladies and gentlemen. Alibaba says its Tongwei Kaiwen AI models are used by over 90,000 corporate clients in China using Alibaba's AI model, which is the number one in China. Moving along, China property stocks surge as home buying easing gains momentum. Incrementally positive on government actions. More news, Hong Kong stocks powered a 9-month high on dividends and property. Dividend stocks, property names lead gains, etc. China to start a $138 billion bond sale on Friday to boost the economy. So fiscal stimulus out the wazoo. China considers government buying of unsold homes to save property market. What's the narrative? They're not going to step into the property market. What did I say? They're going to be forced to step into the Chinese property market. Why? Because they do this every single time. And like they just continue to repeat the exact same playbook. And this time they waited until they were forced. In previous instances, they did it proactively, but ultimately they blink because at the name of the game, a politician's number one job is to stay in power. Alibaba 10-cent beat forecast with strong results, a harbinger of China's improving corporate earnings as economic growth takes root. Alibaba Holding, one of the world's largest e-commerce platforms, reported a 10% jump in net profit, the biggest annual growth since 2021. And more about 10 cent. Saudi Arabia's PIF. Saudi Arabia's sovereign wealth fund and Michael Burry's Scion ride the rally in Chinese stocks as they boost stakes in both Alibaba and JD.com. Bank of America raised their price target on Alibaba yesterday and put $101 price target. Woo, that shows you sentiment. Like, okay, the thing's gone up $20 in the last 3 or 4 weeks, and now you're going to put the price target up, $15, $16, $17. Opinion follows trend. They'll all be upgrading their price targets, and then they'll upgrade them again and again and again. Alibaba, and then they'll do, at 300, they'll have 600 price targets. It'll be hysterical. Alibaba, and we'll be laying off. Alibaba's Hong Kong primary listing plan can open the doors to China's 210 million investors. This is the most important thing we're going to talk about this week. This is a big deal, and I think what you're going to see now, between now and August, when Alibaba completes its dual primary listing in Hong Kong, which means they will gain access to mainland China investors through the Stock Connect, it's going to create, I've seen estimates between 180 million to 210 million new buyers, potential new buyers for Alibaba stock and shares. And I think institutions are getting a whiff of this, and they're going to start to front run it. And that's why you see names like Tepper getting ahead of the crowd, Burry, ourselves, and more. You're going to see the sovereign wealth fund in Saudi Arabia, and you're going to see a lot more trying to front run these 280 million to 210 million new buyers, not on hot air, basically on, wow, I can buy a great fundamental cash flowing business, growing business, now returning to growth, which we're going to spend a lot of time on this week, before 180 million new buyers come in. I mean, you just don't get 2 bites at the apple very often in a career like you can in that situation, in our humble opinion. As always, everything I'm saying is my own opinion, not advice. Go to hedgefundtips.com, click on terms, consult with your financial advisor. We don't know your own situation. We deal exclusively with ultra high net worth and high net worth and family offices and small institutions who are sophisticated, accredited investors and above. And at the end of this lovely video cast, you'll hear and read our beautiful disclaimer. China property sales jump on report of government plans to buy unsold homes. You can't make that up. And then 3 reasons to buy GXO logistics stock now. This was in Motley Fool. not my primary source investing publication, but I thought it was an interesting attention-getting headline. They're talking about the Wincanton deal, which they bought for $1 billion, huge amounts of synergies. This is a UK play. They get like 50% of their revenues in the UK. I love it. Sales cycle is accelerating. The goals are in reach. They talk about their free cash flow, etc. And then here's a note from Stifel. Thanks to my folks over there, you know who you are, where they took the price target up to 74. Again, being conservative, they're very conservative in the whole. They will have to take that up higher as the business starts to outperform. And that one is just leaving the station, so we're very excited about that newer position. Japan's shrinking economy hints at stagflationary risk. All the lemmings got in, and now, and by the way, I'm not blanketing. There are things to do in Japan. But you have to keep in mind, India and Japan benefited from outflows of China the last 2 years. And now all that hot money, as China starts to move, opinion follows trend, is going to flow back into China. But there are some multinationals, there are some trading companies that you can make a tremendous amount of money that get their revenues outside of China, outside of Japan, that happen to be based in Japan. So I'm not poo-pooing all of Japan. There are things to do everywhere if you do good analysis and you pick the right stocks. But I think wholesale, with everyone parading in like lemons after the move, I think that's going to be a miss. UK exits recession with fastest growth in nearly 3 years. There's your GXO play. Auto incentives are back, but high interest rates weaken deals for buyers. So what you're going to start to see is more and more captives saying, 0, 1, 2, 3% APR. And whereas before the pandemic, everyone was doing that, so no one was interested. And if you remember, in 2017-18, when Cooper Standard was at $146 a share, all day long you were seeing these incentives, and that's why the industry was doing massive volumes. The industry got spoiled during COVID, where they could limit the supply and charge above MSRP. Those days are over. Now they're going to have to compete on incentives, which means their captive finance companies are going to have to go back to offering 0. And the minute anyone sees 3, 2, 1% in a 7% interest rate environment or a 10% car financing environment, they are going to not walk. They are going to run to their local car dealer and buy like crazy, and that's going to get the volumes humming again. And that's what Cooper Standard needs. All the operating leverage is in place to just double EBITDA over the next couple of years, and that'll drop to the bottom line. They can get back up to $5, $6, $7 a share in earnings. Then it's just multiple assignment. Trough multiple last cycle was 10, peak multiple was 20. You do the math. We love the story. So everything else is playing out according to plan. It's almost as we go through these headlines, whether about China, it's what we were talking about 6 months ago. And now we're going, here's another one. 3M stock rises as analysts sees turning point. We were talking about this 6 months ago. All these things happened. They did the spin of Solventum. Now everyone's getting excited about the stock. He puts a price target of $140 up from $92. Opinion follows trend. This one's off to the races. This is a large position for us. We had to play the time arbitrage game. Takes a little while, and then when it goes all at once. Remember that theme, ladies and gentlemen. When it moves, it happens all at once. This is not linear, where you got to play the long game. Some people get distracted and they say, oh, this Chinese stock is going up faster today. There are clear reasons why we're in the pick that we're in. And these little rabbits that are running, they're going to get hit by trucks. And the tortoise is going to wind up at the finish line with all the money. So hang out. And if you can't see it, borrow my glasses. Here we go from Carl Quintanilla, the new tenant rent index, implied rent from the BLS. Index of new tenant leases keeps pointing to deflationary rents, ladies and gentlemen. Remember, this is the sticky part. Owner's equivalent rent on a lag basis. Continued data for that. We got a little whiff of that with the nice reports this week, and the market liked it. We're going to see more of that coming to a theater near you. Now, the article of the week, which I was up till 2 a.m. writing after getting back from my Castaway golf experience, playing in the middle of the apocalypse. It was so windy and cold and freezing. But Baba Bad or Baba Beautiful stock market and sentiment results. Is Alibaba the best AI play in China right now? The equivalent of owning a China AI ETF and the cheapest way to play AI globally. This recent article from the Financial Times lays out the nuance required to address these 3 points. So let's go through a number of the key points here. Alibaba has been leveraging its vast cloud computing infrastructure to become a leading investor in China's generative artificial intelligence startups, offering them credits to use the scarce network resources needed to train their models rather than conventional cash for equity funding. This is the most brilliant, amazing thing. Effectively, what they're doing is 2 things. They're locking up all of the AI startups in China into their cloud ecosystem, and not only locking them in as clients in perpetuity, but getting equity in their businesses. So when there are the next Alibaba 300 baggers, they are going to have a piece of it. When I say they, I mean the royal they, meaning we as owners of Alibaba are going to have pieces of all the fastest growing, amazing companies, and we get multiple bites at the apple. Because not only will we get the appreciation of the huge winners, even if 99 out of 100 don't make it, the one that makes it is going to be like 1,000 bagger in China, and we're going to benefit from that. That's number one. Number two, all of them are going to be demanding more and more compute power. So they say, hey, we'll give you this many credits, but for short-term cloud and AI applications, in exchange, we get permanent equity in your business. And when your credits run out, you have to pay us money on top of it. So not only do we take an ownership stake, but we're going to get money from you in the meantime. And in the short term, it doesn't cost us much, even though we can credit that in accordance. So it's just the best of all worlds. Also, so they're trying to replicate the success of Microsoft's investment in US leader OpenAI. Remember, the Chinese are great at copying things, and that was a brilliant thing by Satya with OpenAI. They said, hey, we'll give you credits to use Azure, and now they have a huge equity stake in the fastest growing AI business in the US. Taking prominence, so they're taking stakes in prominent startups, Moonshot, Zippo, Minimax, and O1AI. They've all been developing local versions of US applications such as OpenAI's ChatGPT and Character AI's Avatar Chatbot. What does this mean in English, ladies and gentlemen? This is a new 10-year technology cycle. And what that means is Alibaba is now taking stakes in the next batch of Baidu, which was the Google of China. Ant Financial, et cetera, et cetera. So all of the major players, all the major copycats of the US in the beginning of the internet days, imagine having pieces in all those businesses. You're now going to have pieces in everything that they're copying in the US in China. Alibaba is going to have a piece of those. It's a big deal. It's an absolute big deal, and the magnitude is unreal. So Alibaba led a $1 billion fundraising round in Moonshot AI that valued the startup at $2.5 billion in February. It put $800 million into the developer of the fastest growing Kimi AI chatbot, with just under half coming in the form of cloud computing credits. So they put $400 million of cash and $400 million of credits to get that valuation, to get that value, $800 million of equity in the fastest growing Kimi AI chatbot in China, according to 2 people familiar with the deal. Over the past year, Eddie Yangming Wu has personally overseen the investments, the company seeks to reinvent itself as an AI innovator. Next, this is an important point. which cloud businesses are offering, GPU processing cluster, which Alibaba has. Outsized role in financing the value. Okay, so, this is really interesting. So China's major internet companies are playing an outsized role in financing this wave of startups compared with the previous crop of AI startups dominated by surveillance group SenseTime and MegViv. During that phase of the investment wave, which peaked in 2017 and 2019, large tech investors such as Tiger Global and SoftBank, along with a wide pool of domestic venture capital firms, competed with the internet giants for deals. So Tencent and Alibaba couldn't get into the deals in 2017 to 2019 because there was so much competition. Now the US has backed out and some of these major investors have gotten burned. So Alibaba and Tencent are going to be able to get stakes in all these major companies without much competition at very low valuations. And then when sentiment comes back into the market, the valuations are going to go up dramatically and very, very quickly. So deteriorating relations between Beijing and Washington and a downturn in China's VC industry over the past 2 years have made today's crop of AI startups more reliant on financing from domestic internet companies, which in turn mean they have less negotiating power when determining the price for cloud services, said one person with knowledge to the deal. So not only are they getting equity in these companies in exchange for credits, the limited supply of cloud providers that can give them what they need, and in the case of Alibaba has the most advanced chips, they're basically getting the highest valuation for the lowest cost. It's absolutely, it's kind of like using your stock as a currency when your stock is trading at 50 times earnings and the business you're buying is trading at 5 times because it's a fragmented business or whatever. And that's how you get rich. Ask Brad Jacobs. Alibaba has become a top investor just as it seeks to monetize its board of AI chips. Its hoard of AI chips. Alibaba Cloud purchased high-end NVIDIA graphics processing units, including large orders of the watered-down A800 and H800 series before the U.S. restricted advanced chip sales to Chinese companies. It has them in data centers in China and Southeast Asia, according to a person familiar with the matter. The cloud provider is seeking to capitalize on these chips before they lose value when NVIDIA releases its next generation of AI processors. Wu's focus on AI investments represents a new chapter for Alibaba after a regulatory crackdown. Moving on, Alibaba has become such a pivotal backer of AI startups in China that industry insiders have started to joke, quote, if you want to invest in China AI, just buy Alibaba's stock. It's a China AI ETF, said one manager at an Alibaba-backed AI startup. So let me repeat that, ladies and gentlemen, because maybe this is the second most important thing we're going to cover this week. Quote, if you want to invest in China AI, just buy Alibaba stock. It's a China AI ETF. Okay, moving on. Alibaba, Wu took direct control of the cloud business, pledging to invest in AI and putting the business at the center of his strategy to boost growth. Charlie Day, vice president at Forrester, said Alibaba was, quote, facilitating the startups by offering a public cloud platform with comprehensive capabilities boosted by its broad ecosystem for their open source models, while generating new revenue for its cloud business by providing computing resources to train their models. The structure of Alibaba's investment in Moonshot echoes those of Microsoft and Amazon, under which cash is transferred to the AI startups on the agreement that they will use the money to train and run models on Azure and AWS servers, respectively. However, as one person noted, the difference with Alibaba's investment is that the money is never transferred to the Chinese startups. Instead, it is held in an escrow account that the company can count as incoming revenue. Computing for equity offers are more enticing in China, where cloud resources are scarce due to U.S. restrictions on export of advanced chips. Providing compute is actually more valuable than cash, said one Chinese AI scientist. With the shortage of semiconductors, it's very hard to get access to 10,000 GPU processing cluster, which Alibaba has. So this is unbelievable. And I'd love to say I was genius enough to see this in our original thesis, but there's something to be said for the harder you work, the luckier you get. And this is going to provide probably something beyond what I had calculated in terms of my historic DCF models, extrapolation of AWS versus Ali Cloud, and being 10 years behind. And just for compute demand, AI demand and large language models was barely a nascent idea. And now it's going to probably be the crux of the thesis moving forward, in addition to the return of growth that we're going to talk about in Alibaba earnings, which is our next section. Alibaba earnings more than meets the eye. While everyone was misdirected and focused on this misleading headline, quote unquote fake news, quote, China's Alibaba profit tumbles 86%, though revenue beats estimates. That's from CNN Business. Here's what they missed. Number one, the miss in bottom line earnings was primarily attributable to, quote, mark-to-market losses on the long-term equity holdings in their securities portfolio, not the underlying operating business. So what does that mean? It means that last first quarter, if you remember, was when Xi said, okay, you want COVID, have at it. And he opened the doors and the stock market went straight up for, the first quarter. All these names went up, 50, 60, 70%. And then the economy didn't catch up quickly enough and everyone got depressed again and they all crashed. And just like Alibaba owns a lot of equity securities in new AI companies now, it owns a lot of legacy ones that got smashed in the 82 or 90% drawdown of the K-Web, basically, or the indexes, Hang Seng as well, from early 2001 to basically 2003. And then that rebound caused the mark-to-market on a year-on-year basis to get impaired. And you can see it here in the income statement, investment and investment income. You can see this huge spread here in terms of, it looks like about a 15 billion RMB spread on interest and investment income and share of results of equity method investees went from a surplus to a massive deficit year on year. So that is not related to the underlying operating businesses. And that's the message that was missed and caused people to puke first and ask questions later. And now we're back up to, we're up to recent highs. We're back over 85, up from 68 just a few weeks ago. The second thing they missed was double-digit year-on-year gross merchandise value growth. Double-digit year-on-year, guys. That's not struggling. That's growing. Triple-digit year-on-year AI revenue growth. 7% year-on-year revenue growth for the quarter. $12.5 billion share buyback for fiscal year 2024, $4 billion dividend for fiscal year 2024. Net income adjusted for mark-to-market public security loss was negative 11% versus the misleading headline of negative 86%. Free cash flow was $2.1 billion for the quarter. The decline was attributable to largely due to the dividend, was $2.5 billion last year. It's going to be $4 billion this year. So they're giving that back to shareholders, as well as some major investment to keep up with all the demand for cloud compute demand, and 8% revenue growth for the whole year, 13% income from operations growth for the whole year, and adjusted EBITDA 12% growth for the whole year. Those headlines are a lot different than the ones you saw from fake news. Now, Alibaba announces, here are some highlights here from their initial press release. We're returning to growth, double-digit year-over-year gross merchandise value growth through our focus on customer experience. We're also excited by the accelerated growth of customers and cloud computing revenues related to our AI products. Revenue growth of 7% year over year. Committed to return value to our shareholders. We repurchased $12.5 billion of shares, and the board of directors approved a $4 billion dividend for fiscal year 2024. So it's going to go from $1 per ADS to 1.66 with the special dividend. The decline, the minor decline when you back out the equity investments mark to market, was primarily attributable to increased investments in our e-commerce business and retention incentives granted to KaiNow employees. Net income, net loss. Okay, the net income was year over year, that decline was primarily attributable to a net loss from our investments in publicly traded companies during the quarter, compared to a net gain in the same quarter last year. Remember, after Xi opened the door, I'll just show you. HSI. So if you remember last year, these shot straight up. So the Hang Seng went from, wow, 14,000 to 22,000 in that one quarter. And then in the first quarter of this year, it was back at 14,000. Okay. And now it's going back up. And by the way, for everyone who thinks like, oh my gosh, we've had such a big move in the last few weeks. Oh, I got to take profits. That's fine if you're trading, but like, this is not even the beginning of the beginning. This is like halfway through the first half of the first inning kind of stuff, ladies and gentlemen. So hang on to your hats. And then there will be like a whole slew of you that are like, oh, if I could just get to even, I'll sell it all. And you're going to miss like, it's just human nature. It's mind boggling. All right, moving along. All right, next thing. Impairment. Okay, so they cover that. And then the increase in capital expenditure during the quarter, the majority of which reflect our investments in Alibaba Cloud infrastructure, as well as the special dividend, as well as a special dividend of 10.5 billion RMB from Ant Group in the same quarter. So they received a special dividend from Ant year on year that they didn't receive this year. And my guess is they are retaining all their profits in Ant because the Ant is probably going to re-IPO. I know there's not any scuttlebutt about that, but it would be kind of ironic if the scuttling of the Ant IPO started the crash and the IPO of Ant marks near the beginning of the next cycle of a huge secular bull run for 3 to 5 years in China as that IPO goes out, which would be pretty mind-boggling, and tends to be the way things work. Fiscal year, 8% revenue up. Okay, so we covered all that. Here's number 3 of what they missed. Net income was up 9% for the fiscal year 2024. Non-GAAP net income up 11%. Earnings per ADS up 14% for the year. Free cash flow was $21.6 billion after dividends were paid out to the shareholders and the absence of the special dividend from Ant Financial that was received the year prior. So basically, for those, if you take out those two special situations, you had well above $25 billion of free cash flow. Turnaround story working with improved, even including all the investment into cloud infrastructure and back into the main platform to reignite growth and ward off the faux competition that was around for 5 minutes that I think is not going to be around as long as everyone thinks it's going to be around. Turnaround story working with improved customer retention, purchasing frequency, double-digit online GMV, order growth, Taobao and Tmall group revenue up 4%. Cloud revenue grew 3% year on year despite cutting prices to gain share domestically and internationally. Okay, diluted earnings per share 14%. Special dividend, we covered that. Okay. So improved customer retention, higher purchasing frequency, double-digit gross merchandise value. They also saw, besides seeing a strong increase in the number of purchasers and purchase frequency, they have this 88 VIP member club, which increased by double digits year over year, surpassing $35 million during the quarter. Revenue from Taobao and Tmall grew 4% year on year. Okay, our core public cloud offerings, which include products such as Elastic Compute, database, AI products, recorded double-digit year-over-year growth in revenue. So they're getting rid of the low-margin project-based revenues. We've heard about that in previous quarters. We expect the strong revenue growth in public cloud and AI-related products will offset the impact of the roll-off of our project-based revenues. Cost benefits from our infrastructure scale and advanced technologies enabled us to reduce prices across more than 100 public cloud products this quarter. Our goal is to enhance cost efficiency for our customers and boost public cloud adoption in China. So, we talked about originally that China is basically 8+ years behind the US in digitization, and the US really had their S curve for AWS from 2016 to 2022. And if you extrapolate 8 years out, China is really just starting to gain traction in terms of countrywide digitization. Alibaba is best positioned to benefit from that. That's excluding the compute demand from AI and all of the high margin AI overlay products that are going to accompany that. We're talking just basic digitization. In April 2024, we extended these price reductions to our overseas public cloud offerings, further improving our competitiveness in global markets. Get everyone on the ecosystem locked in, dependent on it, then sell them the high margin add-ons. Number 4, AI-related revenue grew by triple digits year over year. International commerce, AliExpress and Choice grew 45% year on year. Trendyol, that's the Turkish e-commerce, expanded aggressively in the Gulf, becoming one of the most downloaded e-commerce apps in the Gulf. Kainow Logistics grew 30% year on year. Ellie Mae, the delivery services, grew 19% year on year. They bought back $4.8 billion of stock for the year, 12.8 for the 4.8 for the quarter, 12.8 for the year. AI revenue experienced accelerated growth and continued to record triple-digit growth year on year. AI-related revenue was generated from various sectors, including foundational model companies, internet companies, as well as customers from industries such as financial services and automotive. Okay. All right, so we covered a lot of these bullets already. What else did they miss with their misleading headline? The completed buyback that's already completed means that your ownership in Alibaba increased by 5.1% without laying out an additional dollar per share. Let me repeat that. Your ownership in Alibaba increased by 5.1% without laying out an additional dollar for shares. How did that happen? You got bigger slices in the same pie as they retired the stock. That's how buybacks work. They increased the dividend by 66% for this year from $1 ADS to $1.66. And this is the most important thing you need to know. The primary listing in Hong Kong is now expected to complete by August, which means they could have access to the Stock Connect in September. I anticipate, this is opinion, not advice, a rally in Alibaba shares as we get closer over the summer and institutions begin to get ahead of the new buying demand. What is the magnitude of the new buying demand? Try up to 180 million new buyers. See explanation from Perplexity AI below. The estimates are some, SCMP, South China Morning Post says 210 million, 180 million. I don't know. It's a lot of people. It would be like if you live in America and for the last 10 years you've seen Amazon grow like crazy, but you weren't allowed to buy the stock, and all of a sudden you're allowed to buy the stock. Do you think you're going to pick up a few shares? You better believe you're going to pick up a lot of shares. So now mainland Chinese will have the ability to do that. Okay, so here's the explanation from Perplexity AI. I just typed in the question, will mainland China buyers be able to buy Alibaba shares for the first time once the dual primary listing is completed in Hong Kong? Yes, once the conversion is finalized, mainland investors will gain the ability to buy and sell Alibaba shares for the first time through the Stock Connect link with the Hong Kong exchange. This expanded investor base could potentially increase trading volumes and liquidity for Alibaba shares. Could also increase price, supply and demand. Increased demand. Okay, so the dual primary, and then I said, what will this do for demand for the stock? The dual primary listing of Alibaba in Hong Kong will likely increase demand for its shares from mainland Chinese investors. Stock Connect program, blah, blah, blah. We covered that. And then finally, I said, what is the magnitude of new buyers? How many potential new shareholders will there be from mainland China once Alibaba has a primary listing in Hong Kong? And they say this unlocks a vast new market of potential shareholders. There are over 180 million individual investors with brokerage accounts in mainland China as of 2022. This represents an enormous pool of new buyers that can purchase Alibaba shares after the primary listing. This suggests a very significant new shareholder base will be added. The expanded investor pool from mainland China is projected to substantially increase liquidity and trading volumes for Alibaba shares in Hong Kong. So in summary, by gaining primary listing status, Stock Connect eligibility, Alibaba will unlock access to over 180 million new potential investors and shareholders in mainland China. That's the most important message of this week, ladies and gentlemen. As nice as it is to see David Tepper buying the stock, it pales in comparison to that amount in demand coming into the market in the next few months. It's going to be exciting in our view. The company is back to full-on growth mode. You can see it by division. Taobao and Tmall Group, customer management up 4% year-on-year revs, direct sales up 6%, China Commerce Wholesale up 15%, total Taobao and Tmall up 5%, Cloud Intelligence Group up 3%, International Commerce Retail up 60%, International Commerce Wholesale up 7%, total Alibaba International Digital Commerce Group up 46%, Cainiao Smart Logistics up 28%, Local Services up 19%, Digital Media and Entertainment up 15%, total segment revenue up 9%, total consolidated revenue up 8% year on year. That's full-on growth mode for a business that large. Full fiscal summary, you can go through here. Income from operations up 13% year on year, adjusted EBITDA 9%, net income 10%, non-GAAP net income 11%, diluted earnings per share up 14%, et cetera, et cetera, et cetera. So the bottom line is they're back to growth. Everything is hitting on all cylinders, and now you're going to have 180 million to 210 million new buyers. You can go through segment by segment. Now, highlights from the earnings call. Let me see here. Our core public cloud offerings recorded double-digit year-over-year growth in revenue. Strategies are working and we're returning to growth. Double-digit year-over-year growth in gross merchandise value. AIDC up 45%. I mean, it's completely different than the CNN headline. It's just hysterical. They just read the press release. But I know the mandate is negative China headlines, so they do as they're told. But that's going to change. Eventually, the facts are just going to overwhelm the opinions, and people are going to get it, and they're going to see stock price go up, and they're going to get fear of loss, and the headlines are going to change. Okay. As financial services and automotive AI-related revenue accelerated and continued to record triple-digit growth year-on-year. Rapid increase in consumer demand for AI. There's also stimulated growth and demand for traditional cloud computing needs, including general computing, storage, and big data. Therefore, we are actively investing in our cloud computing product matrix, especially AI infrastructure, to capture the monumental opportunities, quote, monumental opportunities. Currently, Alibaba Cloud has established strategic partnerships with the vast majority of leading foundational model companies in China, which basically is code for every single new AI startup is on our cloud. At the same time, Alibaba's proprietary foundational model Tongyi released a 110 billion parameter model in late April, which is on par with the top open source models globally. That's fine that they can compete with the ones globally, but the issue is everyone in China is going to use theirs, okay? Looking ahead, we will deeply integrate our Tongyi large language model with other advanced AI infrastructure to realize synergies and optimization across software and hardware. We aim to create the premier AI development platform that combines outstanding AI capabilities and high cost efficiency. Blah, blah, blah. We are confident that Alibaba's cloud's revenue, excluding internal customers, will return to double-digit growth in the second half of 2025 fiscal. For our overseas e-commerce AIDC revenue, we covered that. Okay, let's get to the Q&A section. Okay, Jian Fang. Okay, we got that. Orders. Trindle is actively investing in cross-border business, achieving very rapid growth in the Gulf region. If you remember, that's the fast-growing e-commerce platform in Turkey and Eastern Europe. It's now one of the most downloaded e-commerce apps in the region. Huge potential for AIDC to grow user penetration in the majority of its markets. Okay, total outstanding shares decreased by 5.1% for fiscal 2024. They paid out 2.5 billion, so you add that to the 21 billion, that's 23.5, and then all the additional increased investment in cloud infrastructure and fending off Temu, and their normalized free cash flow is well over 25. Furthermore, the board of directors approved. We covered that. The dividend's gone up 66%. Plan to return about $16.5 billion to shareholders for fiscal year 2024, up from $13.4 billion in 2023. Okay, they talk about the equity delta. Strong net cash position. Free cash flow this quarter was 15.4 billion RMB, a decrease of 16 compared to the same quarter. The decrease mainly reflected the increase in capital expenditure, the majority of which reflected our investments in Alibaba cloud infrastructure, as well as the special dividend from Ant Group not receiving the same quarter last year, which we covered. Triple-digit growth. Okay, lastly, we've been preparing for our primary listing in Hong Kong and currently expect to complete this by the end of August 2024. We will make a further announcement on the primary conversion date in due course. Okay, we are seeing positive results. They also said during the call, maybe it's in the Q&A, that April and May already look super strong. Digit growth, and thirdly, continuous rapid growth. Okay, we're seeing positive initial results, make it more confident. Okay, now, first question's about the cloud. Revenue growth for the cloud business today, most of that is already being driven, I would say, by AI and AI-related new products. Cloud business will be going forward. A lot of the incremental growth we can expect to see in the cloud business will be related to investment that customers are making in AI. But there's a complementary effect because the more that customers invest and make use of AI, the more demand they will also have for our other various cloud offerings. So the two things go hand in hand. We've been talking about that for a while. The other parts of the cloud business already achieved double-digit growth. Phase out low-margin project-based businesses. Expect revenues to grow faster, primarily driven by public cloud and by AI-enabled offerings, and we expect that we should see that complete disappearance of the drag when, say, 1 or 2 quarters into the new year. So that's right around the corner, ladies and gentlemen. We're back to double-digit growth. I would say for the most part, our public cloud offering have very healthy profit margins. When it comes to AI, of course, we're looking at a 10-year IT new technology cycle. We're in the very early stage of that cycle. So we're talking about healthy margins, but with ongoing longer term investment, Overall, those profit margins from the AI products will be healthy. Okay, using assortment of goods. Okay, better efficiency with respect to high volume selling goods to maintain that unique competitive advantage. Growth trend is sustainable. We can observe, so we are still observing a good, healthy growth in April-May time. They're going to increase their monetization rate with different advertising programs, something like. Oh, this is very interesting. This is from Joe Tsai. Someone's asking about consumer trends. He said, right now, household cash is at its highest point. We're looking at something like $19 trillion of household cash savings that's in the system. He's talking about the Chinese consumer. So the Chinese consumer has the ability to spend, right? Then think all we're looking at is what's their confidence level of spending on a go-forward basis. First of all, we've all seen some of the growth in the services sector in May 1st holidays, and within our platform, we've seen some green shoots. Some discretionary items like apparel and electronics also are actually growing. The growth is pretty good. So what that tells us is consumers are starting to, reflect that willingness to spend. We have no doubt that they have the ability, but the willingness reflects the confidence in what they have about the future. So we're seeing some, positive signals. That's from Joe Tsai, the chairman. And he says, we've been very encouraged that local governments now have been relaxing the property purchase restrictions. So we're all going to wait to see early signs of growth. Okay, good. And Eddie Wu is saying, I was personally part of the whole growth story of Taobao, from zero in revenues and the development of Alibaba from 0 to 100 million to 1 billion to 10 billion, and beyond. So I can tell you that we have the capabilities to put in place those kinds of advertising products that will drive CMR growth. We are certain that we can do that. Okay, we are controlling the pace at which we move forward to ensure a really good experience for our merchants and for our customers. We're really focused on enhancing consumer experience and growing GMV, and we'll move forward on that basis. Okay, next question is about the company's plans to deliver returns to shareholders, and we see those plans now resulting in something like the equivalent of an 8% dividend yield. That's between dividends and buybacks now. Thank you for the question. Long-term, 13 billion. More recent year, we did 16 billion. That leaves us about, they have 30 billion to deploy on share buybacks. Long-term plan we've committed to. Okay. Next, AI focus from Eddie Wu. Largely, anybody develop? Okay, anyone who's developing the foundational model shares the same goal, and that's working towards AGI, artificial general intelligence. So 3 major objectives. First is the pursuit of AGI. Second, internally within Alibaba, integrating our cloud offering with Tangi, our large language model, integrating them tightly so that we can provide our customers extremely well integrated software and hardware offerings, bringing together our cloud capabilities and our AI capabilities and enabling them to benefit from very high, very effective, cost-efficient AI functionality. I think if you look around the world, I don't think there's really any other company anywhere like Alibaba that has cloud as one of its major businesses and AI as one of its major businesses simultaneously. Let me repeat that. If you look around the world, I don't think there's really any other company anywhere like Alibaba that has cloud as one of its major businesses and AI as one of its major businesses simultaneously. And third objective, leveraging Tangi to enable other businesses within the Alibaba group to better develop their own applications and their own businesses. Okay. Just to further expand on the second point I just made about tight integration between our Tangi model and our cloud offerings, our open source model that we've made available is undoubtedly the #1 top open source model anywhere in the Chinese speaking world. It's also certainly the most widely adopted. So when you have developers using our open source model in their own development environment to develop something, when it comes time to deploy it, it's a very natural choice for them to choose Alibaba Cloud because of the very high level of cost efficiency, but also because that's the most familiar environment for them. So that's just a very simple example showing how we can leverage that tight integration between Tongyi, our model, and cloud, and indeed other aspects of Alibaba's business and business models. The only thing they forgot to say is the word flywheel, and that's exactly what they're creating with the best large language model integrated with their Alibaba Cloud. So that's exciting. Moving on to the Bank of America Fund Manager Survey update. You can go through this at your leisure. There's a lot of great information, but we're running short on time. I wanted to focus on Alibaba this week. The key points where managers are finding global fiscal policy to be too stimulative. They've consistently had this view before continuation rallies in equities, whether it was May 2010, April 2018, November 2021, etc. So next, sentiment is elevated but not extreme. Cash levels are low, but they can stay low for a long time, as they did from 2003 through 2007. And then after the crisis from 11 to 13. And then the managers that are stuck in two of the top three most crowded trades, namely long US dollar and short China equities, are going to lose money over time. The PayPal we covered. Stanley Black & Decker, you should listen to this interview with the CEO. As Charlie Munger used to say, quote, "I have nothing to add." Fear and greed is kind of mid-range, getting towards greedy at 60, and the National Association of Active Investment Managers. It looks like managers are beginning to chase. Let's just take a look at what the number came in at today, because it comes out Thursday afternoons, and that was at 89, so about the same. Earnings, top 30 weights for energy, revised up in the last 60 days by 4.96%, 2025 up 2.31 in the last 60 days. Defense and aerospace earnings estimates and revision down 53 basis points for 2024, down 10 basis points for 2025. Earnings we've covered. Oh, I didn't want earnings. I wanted economic calendar. There we go. Okay, so we'll just go through some quick numbers here. Obviously, the most important part was the core CPI and CPI. CPI month on month came in at 0.3% versus 0.4% estimates. That is what lit up the rally. CPI year on year plus 3.4, in line with expectations, down from the last print of 3.5. And core was all in line, and that was enough to get animal spirits flowing a little bit again. And then the initial jobless claims continue to come in higher than expected, which also gives further cover for the Fed. So the jobs market and the inflation numbers gave the Fed a little bit of breathing room this week, and the market simply liked it. Earnings came in at 5.4%. Growth versus 3.2% estimated. And as you can see at the end here, estimates continue to climb. And that's why the market likes it, back up to 244.12 for this year, 277 for next year. And that's that. So the main part of the podcast is over. For those of you who would like to stick around and listen to the Ask Me Anything questions, where listeners send in questions that they have about different stocks, etc., and we give our opinion, not advice. Please stick around. Otherwise, we'll see you next week, same time, same place. And be sure to fast forward to listen to and read our disclaimer. Mitch Lim asks, "Hey, Tom, I found 2 ROIC stocks with reasonable valuations after screening hundreds, GAMB and XPEL. What do you think of them? Additionally, what do you think is a better approach to investing, finding undervalued stocks, or like what Chris Mayer does, buying high ROIC stocks that require you to pay a premium?" There's no black and white answer. You really have to use a method that suits your personality, that works for you, that you can consistently make money with. And the only way you're going to figure that out over time is by experiencing it. I'm not. ROIC is just one data input that I consider. It's almost like it's not a starting point per se. I would say free cash flow is probably my starting point, which because at the end of the day, the purpose of a corporation is set up to make money for its owners. Like cash, not like promised money, like real money. So free cash flow is the key. Then the question is, based on how quickly they can reinvest that cash flow and generate returns on that cash flow, is how much extra I'm willing to pay for that future earnings power. We do like a lot of temporarily impaired stocks that wouldn't come up in looking at or for ROIC, because you'd have to have the experience and understanding and knowing through cycles whether they can return that ROIC back to trend. Okay, so they might have negative ROIC for a year or two. And we like those companies that we have a great level of confidence that maybe they're cyclical, which means they probably have a lower ROIC over time, but they're so impaired down 50, 60, 70, 80%, and yet still have a moat that even recovering back to trend, not having outsized performance, but just a normalization of trend, or in some case, the trend, underlying fundamental trend isn't that impaired. It's just the price trend is impaired, where we can get an expected value of a double or a triple over just a few years because it just got so pounded from price, from this emotional short-term voting machine versus weighing machine. So we do like turnaround situations. We do like high quality businesses, and it's a combination of both. I remember Lee Cooperman once said, if you only own stocks that are near 52-week lows, you're going to have a tough time. And if you only own stocks near 52-week highs, you're going to get your head handed to you. So you need a combination. There's no black and white cookie cutter. Everyone's looking for the formula where they just press a button and 5 stocks are served up to them and they don't have to do any work and they compound their money at 20% a year and double it every 3.5 years. To get those results, it takes a lot more effort and experience and knowledge. And that's why you tune in, and I'm very grateful for that. And I hope you're moving towards finding out what works for you that's going to be helpful for you to meet your goals based on the amount of time and effort and experience that you're going to put into the process. So XPEL, that's kind of interesting. I think that's the one that does the plastic covering. I went to get a car that I have done. Is this the one? They basically have like 100% of, they put this protective stuff on nice cars to keep it from the rocks shooting up. Let me just see here. Yeah, it distributes and installs protective films and coatings worldwide. This is very interesting. No one was talking about it back when it was 12 cents. And now that it's $33, just because it's down from 80 or 90 or 100, now everyone's interested. We'll take a look at the financials, but I just don't buy things that are up 1,000x. And maybe that's a flaw or it's not a flaw, but I won't do it. So, someone else already got the meat out of it, and I'll leave the crumbs to someone else. Could you buy it for a trade back up to 100? Yes, but look, what they do is not that innovative. Like, someone's going to knock them off. It's clear plastic on expensive cars. It's not that hard to figure out. So I just, yes, they have a distribution network. Yes, they have all that stuff. I think it's just they had something at the right place at the right time for the baby boomers that were collecting expensive cars in the peak of their spending years, and they just went to town. And then other people said, wait, if this company can do $1 billion selling plastic, $3,000 to do your car when it probably costs, $30 in materials and, $200 in labor, maybe we can make similar plastic or just find their supplier and knock it off. So I looked at this after I got quoted for whatever it was, $3,500 to do my car. And I'm like, wow, what a business. I missed that one. Error of omission, not commission. I'm perfectly fine with that. let's just see here. I'm sure the numbers are going to still look good. And I'm going to be like, oh yeah, $30, I should buy it. Looks like they did some type of acquisition here for their revenues to jump. They got 8.6 million of cash. Any debt? Probably not. $24 million. I mean, that's surprising that they even have any leverage with the amount of cash they've. Free cash flow, 25 million. So yeah, that's accelerating. Stock price is down. High return on capital, which I was aware of. Yeah, I mean, I see what you're trying to do here, but you're stuck in recency bias. You're thinking like, oh, it was a $103 stock that is now trading at $30. And I'm telling you, it was a 12-cent stock that is now trading at 33. And the growth. All right, so first thing you need to do is go figure out why they had this jump. So what did they acquire? Because they didn't just grow 4x overnight on organic growth. And why did they have to buy that growth? And what's that going to do to their margins on a pro forma basis? So listen to the last 8 calls. I mean, chances are, all things considered, maybe you'll be able to buy it at 30 and sell it at 100. But it looks like the vast majority of the growth. Let me see how many shares are outstanding. Yeah, and you got to make sure these numbers are correct as well. So for me, I definitely understand why you're looking at XPEL, and I looked at it for a second. It's not for me. So I'm going to just leave it at that. Gambling.com group. Let's see what this is. All right, growing revenues, free cash flow looks like it's stabilizing. We don't know. Margins declining a little bit. And let me see XPEL as well. I see something about it. Yeah, so their cash flow is coming down in the stock. Revenues are going up. Okay, back to gambling. Description. Performance marketing company for the online gambling industry. Let's look at the financials. All right, growing revenues. This is a tiny business. GAMB. Doesn't have a lot of history. Let's look at free cash flow. All right, 6.8 million, and the balance sheet. Got good cash. Long-term debt, none. All right, so on paper, everything about this looks decent other than flattish revenue for a couple of years. Oh, why do I have fiscal quarter here? That shouldn't last 12 months. Oh, they do fiscal quarter because there's not enough data. Again, there's not enough data. So for me, this would be a pass because I can't see enough back. But this is one because there's not a lot of information. You better understand your competitive advantage. Listen to a lot of the conference calls. Really understand the competition. I probably wouldn't get involved in something like this, but I do understand why you like it and why you're looking at it. There's just more risk in this one than I'm willing to take. I've seen so many of these international game tech, so many of these like ancillary gaming stocks that look like rockets. They all fizzle out. So it's just a question, is this one going to start to rocket? And what's going to be the catalyst for that? But I just don't like the business. It's too cyclical. It's too hard to predict. There's not enough history. So you really have to understand the edge, and I'm not going to be able to do that in 2 minutes. So you have to do that on your own. But thank you for sending the question. Frank Brown, hope all is well. My question is, what would you say is the sector that provides the most value? I personally think it's energy. Then why did you ask me the question? No, I'm kidding. I feel as though none of this exists if civilization does not harness these many forms of energy, starting with the beginning of time. Okay, I don't deal in these existential questions. I just look at, does the business generate cash? Is it growing? What does the future look like? I believe sometimes it makes no sense, doesn't to the math. Okay, blah, blah, blah. Outside of natural gas, I'm curious to know your thoughts on nickel mining and nuclear energy. Nuclear energy is 10 years out. You get a free option on that with something like Rolls-Royce, something like the bigger companies in the US. So I think that's a way to play. You're not going to realize the benefits of that bet on nuclear for 10 years. So I wouldn't really be investing anything on the basis of nuclear. I don't do commodity-based stocks other than energy. So nickel, hard pass, mining, hard pass. Great pod. When are the hedge fund tips t-shirts coming? I don't even get paid for the ads on this. I don't know who's getting paid for the ads, but I haven't even figured out how to click the button to turn that on. I don't really worry about selling t-shirts, but maybe I'll do it at some point. Maybe, have one of these people do that for me. Jeff Adams. Hey, by the way, thank you for the nice question and commentary, Frank, but on both of those, I'm a pass. Jeff Adams, hey, Tom, I want to thank you for all you do and the infinite value you've provided. I've learned more from this weekly podcast than any class or textbook I've ever read or taken. You're one of my greatest role models. That is super kind, and I'm very flattered by it, Jeff, and thank you so much. With that said, I'd like to hear your thoughts on Whirlpool. This stock is falling 60%, is undergoing portfolio transformation, management is aggressively cutting costs. I like this. I absolutely do like this. I've looked at it. I haven't done anything yet. And but I do think that rates are going to flatten out a little bit, and when building comes back, this is going to go with this is probably going to trade similarly to Stanley Black & Decker and Generac. So I think it's right in the sweet spot, and this is a business that I would own. So I don't even need to go through everything you're talking about. By the way, to your point, 7.3% dividend yield. Remember, dividend stocks are going to come back as well. So you have learned a lot, and you are reflecting that in the type of questions and the framework that you have identified around that, Jeff. And kudos to you. You're going to be very successful over time. Landon H., have you done any work on Seritage after the recent sell-off? Three-bagger in 12 to 24 months as it liquidates assets and returns capital to shareholders. Do you want to be liquidating real estate assets in this market? I don't think so. I think maybe if you can liquidate them at the prices that they have them marked on their books. But, this was a big... Monish Pabrai was pitching the hell out of this years ago, and it just hasn't worked. I mean, we all make mistakes, but this sum of the parts thing for real estate, Macy's people have been waiting forever. Maybe now they're going to realize some value, but you're selling into the worst possible market. It's like, oh, I have 34th Street. Okay. So you got to knock down the building and rebuild what? Apartment buildings? I mean, are you going to build an office? So I don't want to be a commercial or industrial or, mall seller into, or boxes of Sears seller into this market. I think it's probably getting low enough, but, I look at all the people that were in St. Joe's and Howard Hughes Corp. and just have been sitting with it for decades, waiting to realize the value out of the real estate. And I think they eventually will. The question is whether they'll be alive or not to realize the multi-bagger that's embedded in the price of their shares. So I just like things that generate cash. not betting on whether they can find a salesperson to sell the buildings. I'm sure you probably don't get hurt at these values, but why would you just be stuck in that bag for years and years waiting for them to make sales? I mean, I would just pass. Maybe if you see a little change in the market environment and maybe you buy it up a little bit, but too many smart people got bagged in that. Maybe now's the time as they're all puking out to take a second look, but I don't know. Let me just see if this thing even generates any cash. Sorry, death properties, not growth properties. Negative free cash flow. Revenues declining. I don't like this. I don't want to be in the liquidation business. Lucas Neugebauer, thanks for the great content every week. Quick question regarding the BABA. After listening to the conference call, I still didn't understand how they managed to lose 96%. We covered that. The equity securities is they make bets. So they're going to probably have 300 bets on startup AIs. So they have probably 300 bets from the last cycle of, e-commerce businesses, gaming businesses, online gaming businesses, all these subscale businesses, and they got smoked year on year, quarter on quarter. And then we're going to probably get a flip as the Hang Seng recovers in the second quarter, year on year, where it's going to say, oh, net income was up, 86%, and people are going to say, wow, but really the operating business will be up 10 to 20%. The question is whether we'll get that headline or we'll get some other headline. But so that's that. Good question. Next one shows you're reading between the lines. Robert Freeman, can't thank you enough for all the info you provide. You're welcome, and thanks for tuning in. I've been going back and listening to first videos that were pre and leading into the pandemic, and while I'm getting a touch of PTSD was a hard time for me, it is entertaining, and I'm still gleaning bits of learnings. My question is, if you haven't talked about Solventum this week, what are your thoughts about its current state? We're keeping it. We got it for free. We like it. We're keeping it. That's the spinoff from 3M. Chad Lamborn, thoughts on Portillo's. This is interesting. I went to Portillo's. My kid loves it in Texas when we were down there for, I think, Olympic Development Weekend. Thought it was amazing. The stock's gotten smashed. Yeah, it has all that, the high margins and expanding store count. The lower end restaurants are getting hit right now, and I don't know how quickly that's going to turn around. If you look at the Red Lobsters of the world going bankrupt, McDonald's now having to do a $5 meal. So, negative free cash flow as they expand the stores, their margins are going up. I do think this one has legs, but it's like, it's kind of a spec play because it's a relatively small business and there's a huge amount of competition. Let's just take a look here. This negative free cash flow is not exciting for me. It probably is for you. You're like, well, they're using that to buy more stores, blah, blah, blah. I think there are better things to do. I mean, if you love their Chicago-style hot dogs, then, buy a few shares versus buying the dogs, and, then you got a free option. But I'm just not sure. I've seen them all come and go. Habit Burger, BurgerFi, a lot of different pizza chains. So I hope this one's different. I think they've got something special going, but I think it's going to take a while. Even Krispy Kreme, best donut in the world, they can't figure it out. So maybe when they start selling the donuts through McDonald's next year, it'll be something better. But I'm not in love with that. I just don't like the negative free cash flow. Aviel Garcia would like to know your thoughts on Lulu. Financial seems solid. Only brand I own. All right. Abiel, you and my daughter are in the same boat. It's funny, she asked me to go to, after that water polo game, can we walk to Lululemon? And I said, sure. And she picks out a t-shirt, and then we bring it up to the counter, and it's literally a t-shirt, and it's $72. So I'm walking down the street to meet my wife at Ginger Man, which is a restaurant, and I say to Mimi, I said, look, how much do you think it costs to make this t-shirt? And she said, I don't know, $20, $30. And I said, all right, try $2 or $3 and maybe another $2 for labor. So let's call it $5. And we just paid $72 for it. Is it better to be a buyer of these shirts or a seller of these shirts? And I said, probably the vast majority of people in that store, although it was Greenwich, are not billionaires, but the guy who started the company is a billionaire. So which side of the trade do you want to take? And she's like, I like their t-shirts. so there you go. I was trying to teach her a lifelong lesson, but she likes $72 t-shirts. What can I say? Hi, Tom. Oh, so Lulu. All right. L-U-L-U. Yeah, this thing is a machine. I've looked at buying it. Yeah. I just don't think it's come down enough. I think for me, and it's probably not going to do it, but I want to see it closer to like, definitely with a 2 handle on it and maybe like 275 in that range, I'd probably revisit it. I think it's going to take a little time to absorb this huge growth it had from 2017 to 2021. So you might be right, and there's nothing that I can say on a fundamental basis to say, no, you're wrong. But I need such a margin of safety that I can be wrong and not be worried that I'm going to get my double or triple in a reasonable amount of time. And I don't have that level of confidence with this one, despite it being a good brand at a reasonable stock price. Sam R. Okay, so I got this from Sam on the day that they reported earnings and the stock was down 8% and everyone's panicking because they don't read beyond the headline. It says, I can't seem to understand why Alibaba's underperforming. Large cash position. Maybe patience is the only option, but we need to have some big growth somewhere. So it's coming. I mean, look, I think what you should, if you want to chase the shiny objects, go chase PDD and hope their numbers are accurate. I think they're either unsustainable or unreliable. And we covered that with the Financial Times article 4 or 5 weeks ago. JD is a lower quality business in my view. A lot of these are structural squeezes. I've gone through it a million times. We have more outs, more upside, better resources, better moat. We're the tortoise. The hares are going to get burnt out or run over. And I just like my odds. Based on the risk of investing in China, I need to have the protections that I want to have to get a reasonable return on my capital in a reasonable amount of time, actually better than reasonable because I'm taking country risk and government risk. And we're going to get that. So I can't guarantee that. The only one in your list here that I would even consider is Tencent because they're better allocators of capital, but I don't think their cloud business is as good. And that's where I think the big growth is going to come from. And I don't want to be in the online gaming business. So I'll leave it at that. Drew Byrne asks, hi, Tom. Hope you're well. Grateful for your thoughts on GameStop. Just kidding. Yeah. I wondered about your thoughts on Newell Brands in terms of a turnaround. Also, GXO definitely being higher quality than Forward Air. Forward Air's financials preclude you from considering it. Small position, beating down valuations. When have you considered a small? I would do a small position. I've looked at it. It's definitely beaten down, but I like the thesis. I just think GXO is a better business, so I'd rather own the higher quality one. But you may get more ups, but you're going to take more risk, so you have to size it smaller. GXO I can lean into, and I wind up making more money, even if it's a double and a half versus Forward might be a triple, but I could also be roasted, so I have to size it smaller, and I'd rather be able to put some decent size on it, and I can do that with GXO, and it's a much better jockey at GXO. So that Newell, it's a low quality business, but I think the pain is in the rear view mirror, and you could probably get a trade out of this. But for me, I would pass on it. But I do like your thinking on both of those, and I think you can make trades out of both of those, and I like how you're going about things. Sam R asked another question: thoughts on how interest rates will have a premium in terms of the fact that debt's so large and the market is reflecting its increased credit risk. So rates will never go to the lows we've seen before. The only way that this premium actually cuts spending, which will never happen, so higher for longer. Higher than recency bias would lead you to believe. No, I don't think we're going back down to zero. And if we did, that would be problematic because we'd be going into deflation. Higher than recency bias would afford. So I think we're going a little bit lower than where we are. I think that in terms of government deficits, we're going to see a weakening of the dollar. We're going to see debt to GDP come down due to it largely being inflated away over the next 3 to 5 years. And as it comes down, it'll keep a cap on yields. And the last thing you got to keep in mind is you're thinking objectively and rationally, which is where all of the Hayek people get smoked all the time. What you have to keep in mind is now you've got the Fed back in the market for $35 billion a month. As a buyer, going to keep a lid on yields, and that's only going to go up. I think they're going to probably go back up to 60, 70, 80 in the next handful of months and completely stop quantitative tightening and be back in reinvesting the roll-off, and that's going to keep yields under wraps. So there are a lot of factors, but is the Fed funds rate going back to 1% or 2% anytime soon? No, that ain't happening. And I think if they move earlier rather than later, if they get 1 or 2 cuts in this year, they might not have to do a lot more than that. So I agree with your point on that front, but as far as our spending's out of control and yields are going to go up to infinity, I think you're going to be really wrong on that. And I think you're going to see the 10-year yield below 4 when everyone was calling for it above 5. That's going to help mortgage rates. That's going to help housing. And to your point, no one's really positioned for that. So with that said, we're going to be back next week, same time, same place. In the meantime, make it a great one. Been a great week. Bye for now.